If a pension is part of your retirement income plan, then Roth conversions may be a tool that you can utilize to not only control your taxes a little bit better, but also to minimize some of the tax consequences that you may find yourself in later in retirement. So today I'm going to talk about 3 big reasons why a Roth conversion, if you have a pension, is a tool that you may utilize to help lower your overall tax burden in retirement, as well as give you more control over when you pay those taxes. If we haven't met, my name is VanLandingham. I'm the founder of Paresis Private Wealth Management, where we help clients design and implement ideal retirement plans with an emphasis on investment management and planning, income planning with guardrails. If you're not familiar with the guardrail approach, I've made a video on that you can watch that kind of explains why guardrails are so important and how they can give you peace of mind and confidence. Tax planning is also another focus, which again, that's why we do videos like this. And what we believe is the foundation of a solid retirement plan or financial plan in general, and that is estate planning. Today, we're going to focus on 3 reasons why, if you have a pension, Roth conversions may be a tool to utilize for you to control your tax burden in your retirement years. So, first reason here is tax rates. So you can see here, marginal tax rates. This is from 2016 to 2011. But the main reason that I wanted to show this chart was just that, as you can see, that the tax rate has not been stable through time. We went through a 20-year roughly period where tax rates were near 90% after World War II, 1945 to roughly 65, 64 period. You can also see capital gains tax rates were really high and are also, just like the marginal tax rates or tax brackets, at really low levels. Reason number 1 is if tax rates go higher. Right now, tax rates again are low, but we have $32 trillion in US government debt. We're also running at about a $2 trillion a year deficit. So typically, just like when you look here at the World War II in the 40s and 50s, tax rates were really high. We had a lot of war debt. So most experts would agree that tax rates are likely to go higher in the future because of the debt load. So if you believe they're going to stay the same or go higher, then Roth conversions now may be an important planning tool to help minimize the tax burdens as they go up later in your retirement. So that's kind of reason number 1 is tax rates moving higher. Number 2 is most people have the majority of their retirement nest egg in pre-tax dollars, which means they worked for a company and they paid into a 401k pre-tax, their company matched pre-tax. Some people do have Roth IRAs and now even Roth 401ks, but again, the majority of people retiring today, a large percentage of their retirement savings is pre-tax dollars. Then you have Social Security and the pension income. So what this chart right here represents is these dotted lines are, you can take it, but you don't have to take it or pull money like in the 401k. You don't have to pull anything out, but at age 73, you are required to pull money out of your IRA. That is called your required minimum distribution. At age 70, Social Security, it doesn't pay you anymore to delay. So at age 70, that's pretty much you're set in on your Social Security income. Typically pensions started around age 65, some before that. But again, we're just for example purposes, for just this example, we're going to assume that the pensions start at 65. And Social Security is 70 and 73 for RMDs. Now, you can do a couple of things when your RMDs start. So when your RMDs start, you can do a couple of things. You can save it, you can spend it, or you can gift it. And so again, if your pension and Social Security cover your living expenses, then you may be required to pull out more money out of your IRA, especially at age 73, like we were talking about the RMDs. That's mandatory. And by doing that, it can increase your taxes, which it will increase your taxes, but it can also cause some other things like the IRMA deal, which we'll get into in a minute, which is Medicare premiums increasing based on your income. The other thing that you can do, that I've made a video on that as well, and that is a qualified charitable distribution, a QCD, and that is your required minimum distribution. You can pull that money and send it directly to a 501c3 of your choice, nonprofit, and you do not have to pay taxes on it, nor do they. So neither one of you have to pay taxes on it, and that will take care of your RMD for that year. But if you're just saving it, or even just going to spend it and you don't need it, then a Roth conversion could be a tool to use in order to bring down the balance in your IRA account, which means I'm going to go ahead and pay taxes now as I do this conversion. So I'm going to pull money from my IRA or 401k, I'm going to convert it into a Roth IRA and pay the taxes in that year. Now again, if tax rates are likely to go up, then that'll be a benefit to you. If you don't need the income, then that can be a benefit to you, because when you put that money in the Roth, it grows tax deferred inside that account as well, and then comes out tax free. And we also know from a previous video that inheriting a Roth IRA can be a lot more beneficial to your heirs than inheriting a traditional IRA, now that they are required to pull out the entire balance within 10 years. And if it's a large amount, it can cause tax issues, cause them to pay taxes on their Social Security if they're in that age range, increase their Medicare as well. So again, inheriting the Roth could be more beneficial to your heirs. Like, they have to pull that out within the 10 years, but it comes out tax-free. So again, Roth conversions in this situation, your planning period is anything prior right here to the 73 age. So you'll just, even if you're in your mid 60s and you haven't even started taking Social Security yet, then you just still need a plan. My Social Security is going to kick in at age 70, and RMDs are going to kick in 3 years later. How is that going to impact my taxes and my retirement income during that time? So even though it's nearly a decade away, it's important to start planning for it now, especially if Roth conversions will be beneficial to you. And so the last thing that I'm going to cover here is the IRMA Medicare premium. I call anything that increases what you have to pay, whether it's a Medicare premium or actual taxes, a tax. So to me, if the Medicare premiums are increased because of your income, I would say that is a tax. And as you can see here, and there's a couple of things to keep in mind here. So the first one is, if you're single in 2022, but these are for your 2024 Medicare premiums, but if you're single, it's $103,000 or less, and your Part B is the standard $174.70, as well as your Part D is just the plan premium. Anything above $103,000 as a single person, or $206,001 as a married filing jointly, then it would increase your premiums to $244 and an additional $12.90. So this is just based on income. So again, if once you reach that RMD age, you start pulling money out of your IRA that you're required to do, and it pushes you above these limits, or one of these, just depending on how you file taxes, then your premiums are going to be increased for that year. And if it's an RMD and it's likely to stay the same, then it'll be year after year. So the other point of this, and what we see a lot, is that when a spouse passes away, the surviving spouse is shocked in that year following when they have to file their taxes as a single person. And again, that threshold is cut in half nearly. So if they're pulling RMDs, they could go from, if they're pulling out, say, the $200,000, then they're going to be way down here as a single person, and their premiums are going to be a lot higher, especially with the $74 increase in Part D. So again, all these things to take into consideration. Everybody is different. And if you enjoyed this content, let me know with a like or a subscribe. This helps us know if the content that we're putting out is a benefit to you. And if you'd like more information on this, feel free to just send us an email, go to our website, you can schedule a phone call. We're pretty easy to get a hold of, and we don't sell anything, so we just offer our advice and answer any questions that you may have. And until next time, guys, choose your advisors wisely. Your financial health depends on it.